Well, welcome back to Finance Uncut. On today's episode, sell, sell, sell. Right, so I just wanted to share this great visual from Visual Capitalists that shows global GDP in 2021. And for those who think that China's going to become the next superpower, I don't think so. In fact, I'm pretty confident on that. Their demographics stink. They peaked in 2011, go down forever. They got huge debt problems in China. Being a communist country, Mises proved that ultimately in the long run, just like the Soviet Union, they will collapse. China actually remind me a lot of Japan. Aging demographic, a lot of debt, asset bubbles. In saying that, it's not praising the United States either. They've got a lot of problems as well. But looking at the Indonesias and India, they're the two countries that I'm most bullish on in the long term over the next 10 to 30 odd years. So here in Australia, we have the ASX 10, just like the US have the FANG stocks. We have the ASX 10, which is miners, banks, and two others, CSL and Wesfarmers. And you can see they make up half the market. And this is, for me, the risk with index investing or ETF investing, is when these companies are overvalued, or these companies, especially the miners, are in a cyclical decline. Just investing in index can really, and look, you have a look at the ASX since the global financial crisis, it performed poorly, absolutely poorly compared to all other markets until really the bounce off the bottom from the cerveza sickness. But if you have a look at our peak prior to the GFC, it was just over 7,000. And what are we now? 7,400. Yay. So since the GFC, we've made under 400 points on our market. Pretty pathetic. So the IMF says emerging economies must prepare for Fed policy tightening. And we now see that the probability of 4 rate hikes this year is 81.6%. And this is the concern. Listen to a wonderful roundtable with Jeff Gunlock and a whole bunch of very smart people, Jeff Gunlock being the real bond king. And Jeff was saying that can the market sustain even a 1% rise in interest rates? And he doesn't think so. In fact, they're discussing, 3 rate rises will do it. It was a really, really good podcast. It went for about 2 hours or so. So I'll put a link in the description below if you want to listen to it. Really great discussion on the economy and financial markets from who was in there? Jim Bianco was in there, David Rosenberg, Jeff, Mr. Hyman, whatever his name is, and Danielle DiMartino Booth, I think. So anyway, I'll put a link in the description below. You guys can check it out. Now, I recently did this video, huge stock market crash. Kiyosaki, I shared a little video about Kiyosaki, but I shared a whole bunch of graphs and data and things to look out for regarding, a stock market crash and where we are in terms of valuations and whatnot. And it really is insane. And I want to share a clip, and it's a few months old now, but it's a warning and a bit of a rant, just a two-minute rant from billionaire investor Stan Druckenmiller.
But let's start with the Fed and inequality. I don't think there has been any greater engine of inequality than the Federal Reserve Bank of the United States the last 11 years. So hearing the chairman talk about visiting homeless shelters, is very, very rich indeed. I just had the best year I've had in 15 years last year. Everyone wealthy I know is making a fortune. And why are we making it? Because this guy is printing money like there's no tomorrow. And the kids in Harlem, in my opinion, are not benefiting from money printing, but Stan Druckenmiller and other wealthy people are. So for the life of me, I can't figure out why the left is so excited about money printing when all the data says the people that benefit from money printing are rich people that know how to navigate the markets. The odds on bet is we're going to have inflation, and inflation is going to hurt poor people, again, a lot more than rich people. How does this thing end? To me, the asset bubble, which he's blowing up into unbelievable proportions, busts before the inflation ever really manifests itself. That's what happened with the housing thing in 08, 09. We never really got to the inflation because the asset bubble burst. Not dissimilar to what happened in 29. That's not my central case, but let me just say, we've never had a deflationary bust because inflation was too close to zero or 1.5 instead of 2. We've had them because we've had these tremendous asset bubbles. It happened here in 29, it happened in Japan in 90, and obviously it happened in the great financial crisis. And there is no one, no group that will get hurt more by a bust than the poor. They will be first in line to get screwed, trust me.
So I've shared this chart before in other videos, just showing the amount of capital inflow into the stock market, where just in the last 12 months, the amount of capital that's flowed into equities has been more than the last 19 years combined. And that's a big reason that through margin debt and whatnot, more capital has poured into equities, which has pushed the market up significantly. But with the most recent data that I've got, it looks like that capital is rolling out. Or the capital in terms of coming in, the inflows, has reversed, and it looks like it's going to be a substantial reversal here. And without any big fiscal spending, monetized obviously by the Fed as they do, into households and corporates' back pockets, I think this is going to continue, especially as interest rates rise. And it looks like they are priced in. It looks like the Fed will move in February or March, and other central banks around the world will follow. It looks like the Fed is priced in a number of rate rises, or the market has priced in a number of rate rises. And so keep a close eye on this, guys. So I found this chart really interesting, and I had to share it with you. Stocks are stretch versus bonds. Now, as you guys know, I've been talking on this channel for a long time that bonds are the biggest bubble in the world at the moment, in my opinion. And so when I saw this, it was going against what I have been saying. And it's actually saying that stocks are more overvalued than bonds when you look at the standard deviations. For those of you who aren't familiar with standard deviations, let me just cut to a clip that explains it a little bit more.
Have we discovered a new particle in physics? Is a manufacturing process out of control? What percentage of men are taller than LeBron James? How about taller than Yao Ming? All of these questions can be answered using the concept of standard deviation. For any set of data, the mean and standard deviation can be calculated. For example, 5 people may have the following amounts of money in their wallets: $21, $50, $62, $85, and $90. The mean is $61.60, and the standard deviation is $28.01. How much does the data vary from the average? Standard deviation is a measure of spread, that is, how spread out a set of data is. A low standard deviation tells us that the data is closely clustered around the mean, or average, while a high standard deviation indicates that the data is dispersed over a wider range of values. Standard deviation is used when the distribution of data is approximately normal, resembling a bell curve. Standard deviation is commonly used to understand whether a specific data point is standard and expected, or unusual and unexpected. Standard deviation is represented by the lowercase Greek letter sigma. A data point's distance from the mean can be measured by the number of standard deviations that it is above or below the mean. A data point that is beyond a certain number of standard deviations from the mean represents an outcome that is significantly above or below the average. This can be used to determine whether a result is statistically significant or part of expected variation, such as whether a bottle with an extra ounce of soda is to be expected or warrants further investigation into the production line. The 68-95-99.7 rule tells us that about 68% of the data fall within one standard deviation of the mean. About 95% of data fall within two standard deviations of the mean, and about 99.7% of data fall within 3 standard deviations of the mean. The average height of an American adult male is 5'10", with a standard deviation of 3 inches. Using the 68-95-99.7 rule, this means that 68% of American men are 5'10", plus or minus 3 inches. 95% of American men are 5'10", plus or minus 6 inches, and 99.7% of American men are 5'10", plus or minus 9 inches. So, this means only about 0.3% of American men deviate more than 9 inches from the average, with 0.15% taller than 6'7", and 0.15% shorter than 5'1". This reasoning suggests that LeBron James is 1 in 2,500 and Yao Ming is 1 in 450 million. In particle physics, scientists have what are called 5 sigma results that are 5 standard deviations above or below the mean. A result that varies this much can signify a discovery, as it has only a 1 in 3.5 million chance that it is due to random fluctuation. In summary, standard deviation is a measure of spread. Along with the mean, the standard deviation allows us to determine whether a value is statistically significant or part of expected variation.
So there you go. There's standard deviations, and you can see from this chart. So there's an S&P 500 inflation adjusted chart, and it shows the trend line, and it is an exponential growing trend line because that's generally what the market does. It grows, and as of the 7th of January, the S&P 500 value of $4,677 is 75% above the modern era trend line. Now, we have a look at this. You can see back in the late 60s, it really peaked on an inflation adjusted basis and went down for quite some time, nearly 20 years. Actually, probably longer, you could argue that. It wasn't until the mid-90s where it got back to that inflation adjusted peak in the late 60s. Then we had the bubble, dot-com bubble. It burst. It fell below the trend line. People call the GFC a bubble in stocks. It was really a bubble in real estate. I don't think it was a bubble in stocks. However, stocks got hammered and probably became the cheapest in terms of, looking at a value from its trend line. And then since then, it's just gone ballistic. So, if we do have a market crash, history says that it sometimes goes below its trend line. That's a big fall from where we're at the moment. So we just got to be careful. And looking at the standard deviations, you can see it's above 2 standard deviations. And as David Rosenberg and others were talking in that Jeff Gunlock roundtable, is 2 standard deviations above the trend line is very high and very overvalued. So, yeah. And then this is just a more close-up since 2000. So yeah, we're pretty much right around that the .com bubble in terms of being above Trendline, and actually we were at 79% by the end of December. So it's actually come down a little bit since then. But Jeff Gunlock did say in that round table that this is all Fed driven. When you lower interest rates so much, so what he argued was, based on where interest rates are today, you could argue that the stock market is potentially fairly valued, because you use, say, the 10-year as a discount. That's your risk-free rate that you discount off, and he argues that you could argue that the stock market is fairly valued. However, central banks raise interest rates, then all of a sudden the stock market becomes extremely expensive, and the same thing could be said about real estate. And actually, stay tuned, because I'm actually going to do a video on the real estate market. Now, for me personally, I've got vested interests in both the US and Australian housing market, but what I talk about in this video will be, it'll be relevant for people in Canada, New Zealand, the UK, right across really the Western world, because we're all seeing the same issues there. And it all comes down to central banks. Because central banks have lowered rates to where they are, it's pushed up asset prices. It's created companies to be able to issue debt at very low rates and buy back stocks. You've had people that need to get a yield, so I'm talking about older people, retirees and whatnot, pension funds, all this sort of stuff, where you can't get any return on cash or a yield on any type of bond. So they're forced to go into the stock market, or they're forced to leverage and buy real estate. They're forced to take on more risk, going out that risk curve. And so there is so much more capital that's been pumped into the markets because of Fed policy. Now, if the Fed and central banks, actually, I should say, because it's a problem all around the world, if they change policy and revert, then in my opinion, we're going to see markets very shaky indeed. And when the selling starts, because of the ETF, because of index funds, when the selling starts because of the margin debt, and go back to that video, where I had Kiyosaki on the thumbnail. Check out that video. I showed graphs about margin debt, capital flows, all of that sort of stuff. When that starts hitting, the bottom of this thing, the bubble, where that air, there's a lot of air under this bubble. The question is, how far does it fall before central banks, and Powell does his typical Powell pivot? Or do they just let the thing fall? And that's the reset that we're having. I don't know. I can see this thing on a knife's edge, and I've said this before. Do they risk the dollar, or do they risk asset prices? Do they pop the debt bubble, or do they risk the dollar? And at the moment, they've been showing that they'd rather risk the dollar. But yeah, we'll have to wait and see. Anyway, what do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, guys, and I'll see you again on another episode of Finance Uncut.